Everyone says you should start investing in your 20s. If you pick up any personal finance book or scroll through a financial news feed, the narrative is always the same. Start at 21, let compound interest do the heavy lifting for 40 years, and retire a multi-millionaire. The message between the lines is often much darker. It suggests that if you didn't start early, you've already lost the game. It implies that if you are just now looking at your brokerage account in your 40s, you're behind the curve and playing a desperate game of catch up. But what if your 40s are actually the most powerful decade to build wealth? What if the start early mantra, while mathematically sound, ignores the practical reality of how human beings actually earn and manage money? By the end of this video, you'll see why being 40 plus might be your biggest financial edge. We are going to look at the higher income advantage, the emotional stability advantage, and a smarter risk management strategy that only works well once you've gained some life experience. Forget the idea that you've missed the boat. The boat hasn't even reached its full speed yet. There is a myth that keeps millions of people stuck, and it's the "I'm too late" mindset. This is a psychological barrier that acts as a self-fulfilling prophecy. When you hit 40 or 45 and you realize you haven't saved what you should have, the comparison trap kicks in. You see 25-year-olds on social media bragging about their portfolios, and you feel a sense of paralysis. You think, why bother? I've missed the first 20 years of compounding. This fear of not having enough time causes people to either give up entirely or, even worse, take reckless risks to try and make up for lost time. But we need to flip that script. Investing is not just about time. Time is a multiplier, yes, but it's only one part of the equation. Wealth building is actually a combination of three things: time, capital size, and emotional control. While a 20-year-old has the time, they almost never have the capital size or the emotional control. In your 40s, you are entering the phase where the other two factors, capital and control, reach their peak. This is the moment where you stop playing the game with pennies and start playing with real dollars. This leads us to advantage number 1, your peak earning years. The standard advice often forgets that most 22-year-olds are broke. Sure, they have 40 years of time, but they might only be able to scrape together $50 or $100 a month to invest. In your 40s, you've reached a level of career maturity, you've had the promotions, you've developed specialized skills, or you've built a business with some level of stability. Many households in their 40s are also dual income, often with the highest salaries of their lives. This creates a massive surplus of investable capital. Let's look at a simple side-by-side projection. A 25-year-old investing $200 a month for 40 years at a 7% return will end up with about $500,000. That's great, but a 45-year-old who can suddenly pivot and invest $2,000 a month because their career has peaked can reach that same $500,000 mark in just 12 or 13 years. Compounding works faster with bigger contributions. When you have the income power of a 40-year-old, you can compress decades of slow growth into years of aggressive progress. You aren't just saving, you are deploying capital at a scale a younger version of you couldn't even imagine. And this isn't even the biggest advantage you have. Advantage number 2, better decision making. We think of the stock market as a place of numbers, but it's psychological. Young investors suffer from FOMO. Because they seek a shortcut, they chase the latest craze, cryptocurrency, or risky tech stock. They're more inclined to panic sell when the market declines, since they haven't lived through enough economic cycles to know the sky isn't falling. By 40, emotional maturity is a superpower. There were 2008 crashes, 2020 lockdowns, and market corrections. You learned from your prior financial blunders, such buying too much property or automobile. This experience lets you prioritize cash flow and stability above 10-bagger stocks that frequently fail. Maintaining a plan when things get dull is your strength. Because of their ability to stay in the seat, 45-year-olds with consistent index fund strategies usually outperform 25-year-olds chasing hype. Wait until you see the hidden superpower that only activates at this age. Your 40s hidden superpower is clarity. This is your mid-video surge when strategy becomes intentional. At 20, you have no notion what life will be like at 60. It's unclear if you'll have children, reside where, or want a certain lifestyle. Your investment approach is frequently unclear because your goals are. The fog lifts in your 40s. Retirement is now a tangible horizon. You realize the cost of your kids' education. You recognize your mortgage. Loss has taught you your risk tolerance. Your definition of enough is most crucial. You want to fund a specific life, not win an eternal wealth game. In your 40s, investment becomes a purpose rather than a pleasure. However, even with these advantages, there is a biggest mistake that 40-year-old investors make that can sabotage everything. This mistake is driven by that lingering fear of being too late. Many people in their 40s become too conservative. They see the retirement horizon and they move everything into cash or low-interest savings accounts because they are afraid of a market crash. Or they do the exact opposite and take extreme risks, pouring money into unproven ventures because they think they need a miracle to retire. The practical correction is to find the balance between growth and income. You don't need a miracle, you need consistency. You need a strategy that involves dollar cost averaging into a diversified portfolio. Stop waiting for the perfect timing to get back into the market. If you are sitting in cash because you're waiting for a crash, you're losing more to inflation and missed growth than you would likely lose in a temporary correction. Your goal isn't to catch up fast, it's to grow steadily. To make this actionable, let's look at a practical investment framework for your 40s. It doesn't have to be complicated. Step 1, define your retirement target number. How much do you actually need to live on per year? Step 2, calculate your monthly investable surplus. With your peak earnings, be honest about what you can truly put away once the wants are trimmed. Step 3, build a core portfolio using index funds or ETFs that track the total market or the S&P 500. This is your engine. Step 4, add a growth allocation. This could be selective equities or technology-focused funds that provide a bit more upside. Step 5, consider income-producing assets, whether it's dividend-paying stocks or exposure to real estate through REITs. Start building the income floor that will support you later. Finally, step 6, perform an annual rebalance. This keeps your risk in check and ensures you aren't overexposed to one area. This simple framework, executed with 40-year-old discipline, is incredibly hard to beat. Reframe the time advantage again. People think you need 40 years to have a runway, but consider the 20-year power window. If you're 40, you have 20 years till 60. You have 20 years until 65 if you're 45. 20 years is a long time for compounding to work. Investment legends like Warren Buffett built most of their wealth in his later years. The compounding procedure is back heavy. Growth between years 15 and 20 is much greater than between years 1 and 5. Because you are contributing more capital today, your 20-year window can yield more wealth than a 20-year-old's 40-year window if they are contributing little. Compounding is about consistency and the size of your snowball, not just your market experience. For the first 5 years, most people waste this 20-year window grieving the 20 years they lost. Do not be that. Watchers in their 40s should hear this. You're current. Your location is ideal for making a big impact on your future. Your youth lacked capital. You now have income experience and you know what matters. Your urgency and clarity help you focus and realize what you're fighting for. This decade could transform your family and legacy. With your wisdom, now may be the ideal moment to invest. 20 years ago was the best time to invest, and the second best time is now. This decade is your best chance. You've overcome youth's distractions and avoided old age's limits. You have financial sweet spot potential. You'll be amazed at where you can be in 10 or 15 years if you maximize your peak earnings. Stay emotionally disciplined and follow a defined plan. You need to determine which assets are worth your time in your 40s. How to bridge the gap. Watch our next video on best assets for late starters. Check your progress with our breakdown of how much you should have invested by 50. Start a conversation in comments. Age and largest 5-year investment goal. Do you feel like you're playing catch up or determined to maximize your peak earning years? Don't let too late prevent you from experiencing just in time. Start building today with your experience as your greatest asset.